and welcome to the session. This is Professor Farhat. In this session, we would look at capital gains and capital losses for corporation. This topic is covered in an income tax course, the CPA exam regulation section, as well as the enrolled agent exam. And specifically on the CPA exam, it is covered substantially. And the reason is this. They will try to ask you questions about the capital gains when it comes to individual as well as corporation. They will try to simply confuse you because it's an area that you can be easily confused about, because they could be asking you about corporation, or they could be asking you about how an individual taxpayer treats capital gains and capital losses. That's why the topic is important. As always, I would like to remind you, my viewers, to connect with me on LinkedIn. If you have a LinkedIn account, please connect with me on a professional level. If you don't have a LinkedIn account, I strongly suggest you get one. If you're a Facebook user, you could like my Facebook page and connect with me on a personal level if you choose to. You want to make sure you subscribe to my YouTube. This is where I house all my lectures. If you like my YouTube lectures, please like them, share them, put them in playlists, let the world know about them. This is my Twitter account, and I do have a website. On my website, you could always find CPA offers, and for now, I'm running a special from Becker CPA Review. You could either buy the all 4 parts at $24.93 or the Becker bundle for $29.87, which include digital flashcards as well as a final review. You can go to my website, farhatlectures.com, to check out those offers. Again, this offer will end at a certain time. I will have other offers for you. Most probably you are either a CPA student or an accounting student if you are viewing this lecture. Whether you're a CPA candidate or an accounting student, signing up for a CPA course will help you substantially for both reasons. So let's go ahead and keep working with the key differences in computing the income taxation for individual and the corporation. And here is a list of the differences. And we already covered accounting period and accounting method in the other section, in the prior session. In this session, I will work on capital gains and capital losses. And recapture of depreciation, this is already done. You can find it in the playlist. But today we're going to be focusing on capital gains and capital losses. So it's very important to remind you, how do individuals treat capital gains and capital losses, and how do corporation, which is the topic of this session, treats capital gains and capital losses. Individuals, hopefully you remember this, net capital gain subject to the following preferential treatment. Remember, if you have net capital gain, okay, what you can do, if it's a short term, remember, when you have a capital, we have short-term capital gain and we have long-term capital gain. The short-term capital gain, basically you will tax it as ordinary income. So it's based on your regular tax rate. Whatever your tax rate is, that's gonna be subject to that. And that could go from 10 up to 37, depending which tax bracket you are in. That's for the short term. For the long-term capital gain, remember, they can be taxed at nothing. They could be 0%, 15, or 20, depending on your tax bracket. Now, I'm not going to go over the tax bracket here because I did go over those tax bracket way much in detail in prior chapter. So make sure you know when you're not taxed 15 or 20. Now, if you have a net capital loss, simply put, you have a loss overall, what can you do? Well, you can deduct up to 3,000 of the losses against ordinary income. So you can deduct up to 3,000 of your capital losses. If you have more than 3,000, you can carry those to future years. And those carryover do not lose their identity, but remain either a long-term or short-term, whatever their character is, whatever their short-term or long-term. So notice here, to wrap it up, if you want to think about it, when we have capital gains and capital losses, we could have short-term capital gain, we could have long-term capital gain, short-term capital loss, and long-term capital loss. And the way the gains are treated are different, whether it's short-term or long-term. And however, the losses, you can deduct up to 3,000 and the remainder is carried indefinitely. That's the individual. And hopefully this is a quick review for you. Now we need to talk about the corporation. So how does the corporation treat capital gains and capital losses? Well, first thing, there's no special tax rate applied to capital gains. So if you have a capital gain, guess what? They don't look at it any differently. They don't look at it any differently. Any differently than what? Any differently than any other source of income. So it's basically, it's taxable at your regular rate. So they don't treat it any differently. So the entire gain is included in the income subject to the normal corporate tax rate. So it's, you know, you have a capital gain. It's not any special, it doesn't get any special treatment. Now, corporation cannot take a deduction for a net capital loss. What happens if you have an overall capital loss? Well, individual, you can deduct 3,000. Well, for corporation, the only thing you can do with capital losses is offset capital gains. So if you have capital losses, good. The only thing you can do is use it against capital gain. Use it against capital gain. That's the only thing you can do with capital losses. Okay? What happens if you have too much capital losses? So in other words, let's assume you have 3,000 in, let's use something other than 3,000. Let's assume you have 5,000 in capital gain and 20,000 in capital loss. Well, overall, you have a loss of 15,000. What can you do with that loss? Well, you could unused capital loss are carried back 3 years and carried forward 5 years. So what you can do, you can go back 3 years, or you can go forward with them 5 years, carry them for 5 years. All carried over losses are treated as short term. So it's just basically, it doesn't make a difference. Whether you call it short term or long term, it doesn't make a difference. Okay? Why? Because it doesn't have any special treatment. Okay? And the best way to illustrate this is to just take a look at two examples. Robin, an individual, incur a net long-term capital loss of $7,500 for year 2018. Assuming adequate taxable income, Robin may deduct $3,000 of his loss on the 2018 return, and the remainder, which is $4,500 of the loss, is carried forward to 2019 indefinitely until they use them up. Okay? And they are carried as long-term because they retain their character as long-term. Now assume that Robin is a corporation. Well, none of the losses of the 7,500 losses incurred in 2018 can be deducted in that year. Why? Because they don't have a capital gain. However, what can they do? They can carry back the loss to 2015, 16, 17 in that order. You go to the latest, then 16, then the most recent, and offset it against any capital recognized in those years, any capital gain. What happens if you don't exhaust those 7,500? If the carryback does not exhaust, then you carry them to 2019, 2020, 2021, 2022, 2023, the next 5 years in this order. And the long-term capital loss is treated as short-term, and any carryover, just there is no special treatment. Okay? And the best way to put all of this together is to work an example, just to kind of show you how this all fits together. Okay? During 2018, Gorilla Corporation, a calendar year C corporation, has net short-term capital gain of 1,500. So net short-term capital gain of 15,000. Net long-term capital loss of 105. Net long-term capital loss of 105. Wow, that's a lot. Okay. And taxable income from other sources, 460. That's taxable income from the business. Okay. And here we have data from prior year, 2014. They have net long-term capital gain. 2015 net long-term capital gain. 2016 net long-term capital gain. 2017 net long-term capital gain. How are the capital gain and capital losses treated on Gorilla's 2018 tax return? So simply put, how are they treated? Okay. Well, simply put, if we have a gain and a loss, we net them out. Overall, we have a loss of 90,000. And what can we do with that loss for 2018? For 2018, nada, nothing. Remember, losses, we cannot do anything with losses for 2018 because that's the question, what the question is asking. Okay, that's why. Now, determine the amount of the 2018 capital loss that's carried back to each of the previous years. So remember, we cannot use it now, but we can use it to offset, either go back 3 or go forward with it 5. Let's go back 3 with it. So if we have $90,000 in losses, what can we do? Well, going back 3 years, that's 1, 2, 3. So we're going to start with Those are the years that we can offset. And we'll start with the latest. We start with 2015. So what we do for 2015, we're going to file a tax return, amended tax return, and cancel our gain, 18,000. That's done. For 2016, we're going to also file a return and cancel our gain. Oops. So this is 2015. This is 2016. And for 2017, we're going to file an amended return and cancel our losses. Overall, total carryback is 63,000. So guess what? Of the 90,000 losses, we used up 63,000. We still have losses of 27,000. What are we going to do with this $27,000 losses? This is going to be carried forward to 2019 in case we have any gain, 2020, 2021, 2022 till 2023, up till 2023. Get carried forward 5 years. Compute the amount of capital loss carried forward. I already did this, 27,000. And indicate the years to which loss can be carried. Again, we already talked about this. Okay. Now, if Gorilla is a sole proprietorship rather than a corporation, how would the owner report these transactions? What we're saying is Gorilla is not a corporation. Gorilla is a sole proprietary. So what can they do? Well, remember, they computed their net, and their net was 90,000. What can we do with this 90,000? Well, with this 90,000, we can deduct 3,000 for year 2018 because you are allowed to deduct 3,000 against even ordinary income. So you are allowed to do so. Well, if you deduct 3,000, let me go back there. If you deduct 3,000, what's left is 87,000. So if you deduct 3, you still have 87,000. Now, what can you do with this 87,000? This 87 will be carried forward indefinitely, and it's going to be long-term capital loss. Long-term capital loss, because it retained its character for the individual. Now, again, as I said, this topic is important. It's on the income tax, so on the CPA exam. So make sure you do understand the difference between how an individual and how a corporation treat capital gains and capital losses. If you need additional lectures, please visit my website. If you happen to do so, please consider donating. And if you're studying for your CPA exam, as always, study hard. It's worth it. Good luck.